Welcome to our latest quarterly update. Once again, Gregor Hirt, our global CIO Multi Asset, is here with me. Hello, Greg.
Hi, how are you doing?
Good, thanks. Good to see you. Greg, there's a lot going on in the markets at the moment. What should investors be focusing on?
Well, there is indeed a lot happening, and it's important to filter out the noise. First, tariffs are still a live issue, while many aspects of this may appear settled and supported by the recent rally in equity market. We know that, with Trump, this issue could raise its head again, and we should not take anything for granted. Second, while many economies are proving to be more solid and resilient than expected, with pre-tariffs inventories helping here, there are still labor market issues that can potentially act as a signal for further problems down the line. Indeed, while we remain cautiously optimistic, I like to say, on the economy, especially the risk of stagflation in the US is underestimated by market participants. I think that the third point that is important, the Trump administration's continued focus on the Fed and also other institutions may have unpredictable outcomes and will be keenly observed by all the market participants, especially in the treasury market by the bond vigilantes.
Greg, you mentioned stagflation. How have your views on the bond markets changed recently?
Well, in the US, we like steepener trades that take advantage of escalating yield differences and are, on the contrary, avoiding taking long duration risk. On Japanese government bonds, high inflation and uncertainty at the top of government mean that some worries continue here. Large holdings by life insurers at the long end of the curve may also impact pricing, should they need to diversify, which I think will be the case. And turning to Europe, we are, unsurprisingly, taking a cautious approach to French markets, while bonds, German bonds, remain attractive as a hedge, and also that thanks to a greater issuance activity. Switzerland, my country, also remains strong in this respect, but we know that the market lacks the necessary liquidity.
Thanks, Greg. You remain generally positive on equities. What's driving your sentiment here?
Well, this moderate optimism is here driven more by shorter-term momentum and robust earnings, especially with regards to the tech sector, than to the fundamental part of the economy. Furthermore, low volatility levels have also allowed us to enter risk, but while hedging tails as a reasonable cheap price. Finally, differentiation regionally and between themes is also helping a lot. For instance, we are positive on emerging markets thanks to the under-ownership, attractive valuation, strong pricing momentum, and a weak US dollar. But then we are also more cautiously overweighted in the US, while treating tech quite separate.
And how about currencies?
Well, a very important question indeed. Central bank independence is key for us, and we're really worried that the US dollar may suffer further due to potential developments in the US. Nevertheless, carry trades, so a positive carry for the US dollar, continue to be supportive of the greenback and therefore leading to a very slow and more long-term deterioration of the US dollar. Many emerging market currencies, on the other hand, are generally showing promise due to monetary and fiscal discipline and GDP and productivity growth, we have to say also. However, this is more a strategic theme, so medium term, and we are very active in terms of country selection here. So active allocation is key. On the yen side, 1 month ago, we have reduced our exposure to neutral in light of the issues already mentioned.
Greg, finally, a perennial topic for us here. How do you see the gold market developing?
Oh, the usual question, like we have been long since 2022. We think gold has further legs, right? Central banks' holdings are growing. It is now the second largest currency on their balance sheet after the US dollar, but before the euro, while the market is also being driven by private investors in China and in India. Furthermore, we're seeing a degree of decorrelation between gold and traditional factors such as real interest rates and the US dollar. So we remain long positioned in gold.
That's great. Thank you, Greg. Insightful as ever, and thank you for joining us.
Thanks a lot, and looking forward to seeing you next time.